Questions about getting a loan? Today, we're sitting down with one of our mortgage partners, Todd Flesner. We would like to introduce you guys to Todd Flesner. Todd being top 1% of loan originators in the country, and in his 18 years in the business, he's originated thousands and thousands of residential loans.
Well, great. It's a pleasure to be with you here today and to share a little bit of what I've learned over the course of my years in the business with your viewers.
Sounds great. The first question for you, Todd. Many of our buyers assume that they absolutely have to have at least 20% cash worth of like the purchase price of the house.
Well,
Is it true?
Yeah, that's a common misconception that people have, that you have to have at least 20%, in some cases even more for a down payment. The nice thing is there are options that people have.
Really? How is it possible?
Well, there are a number of factors that lenders look at, and down payment is one of those. But particularly here in the Bay Area where housing prices are so high, it can be a challenge for people to get as much cash as they might need for a large down payment. And so a lot of banks and mortgage companies have recognized that challenge and have engineered loan products that only take a small down payment, as little as 10% for perhaps a $2 million purchase.
But nothing comes for free, right? Like it comes at certain cost.
Well,
so what, like if you would I look at it as either a higher amount of cash down,
mm-hmm.
or better interest rates or better loan conditions long term. Can you comment on this?
Well, absolutely. Banks are always managing or balancing risk, right?
Yes.
And so the less that you have down, the higher risk that is for the bank. They're going to look for a little bit higher reward, i.e. maybe a little bit higher interest rate on that. But for somebody who's looking to buy a home, they have choices in terms of how do they use their money. Is it better for them maybe to pay a little bit higher interest rate, but keep their cash in the bank, or in the stock market, for instance? If they had to take all that money out and put it into a home, there's an opportunity cost perhaps, or tax consequences they might have on liquidating those funds.
Yes, so it's more like a financial planning question, which probably is very individual. It's like depends on the customer and each customer's situation.
Absolutely. Everybody kind of has their own financial situation. They have their own unique characteristics and their own goals. And so that's what we try to do, is try to help people understand what their options are with the goals that they have. And if preserving cash is one of those, there are options.
Okay, sounds great. So another question for you, Todd. We all know that the credit score is very important in the loan origination process. What are your suggestions to the buyers on how to be qualified for the best loan programs?
Well, you're absolutely correct. The credit score is critical. In fact, many loan programs have a minimum credit score that you need to be able to qualify for that particular loan. And the interest rate that you pay can be based on the actual credit score. So knowing what your score is, managing that process is critical for people to get the best deal when they're shopping for a loan.
So what they should or should not do? What would be your advice?
Well, one is to start early. A credit score is not a static number. It changes, all right? And so changes in your behavior, things that you do that impact your score, can be detrimental to you while you're in the shopping process.
Give us some examples.
Well, opening new credit accounts, right? Going out and buying a new car. Multiple credit inquiries sometimes can.
So it's a big no. Do
Yes.
not buy cars. Do not open new credit accounts, and do not do loan shopping?
Well,
credit shopping?
Yeah, there are some things built into the credit algorithms and that will protect people from multiple inquiries. You get over 2 or 3, then those start to add up as you have more and more inquiries. So limit it. Work with perhaps a mortgage broker who can shop for that loan at multiple banks without multiple credit inquiries. So that's one way to do that. The other is your balances on your credit cards make a big difference. And when we run that credit score, let's say you charge everything every month and pay it off at the end of the month when the bill comes.
Mm-hmm.
Well, if we run that credit score when your credit card's maxed out, your score is going to be lower versus if we run it after that payment is cleared and you have a low balance on an account. So that can have an impact. So getting started early, I have credit tools that we can utilize. It's called a credit maximizer, and we can actually run that through the software. And for folks who are on the edge, we can look see, are there ways they can maximize their score? Is paying down a credit card a good idea? Do not close credit accounts while you're in the process of a loan to this. People think if I close down an account, then that reduces the amount of credit I have. There's only one thing that's worse than bad credit, and that's no credit. So as soon as that account's closed, the good credit history you might have is lost.
Oh, I see.
All right, so we want to keep that account. If it's good, and we want to keep it active, that will help to maximize your score.
This is a great suggestion. So if you've been paying off certain bills very accurately for many years, keep it on. Do not close it, because it's sort of like from your college, right? You're like, you have a good transcript.
Right.
Don't throw it away. Show it.
Exactly. We want to keep that good credit history there as a part of your credit file.
All right, Todd. And another question for you. Can you please tell us what is the difference, or what are different levels of pre-approval for the loans? We know pre-approval, pre-qualifications. Can you please comment on this?
Well, yeah, there are various levels of folks or approval that people can get. And a pre-qualification really is just a scanning of their particular situation and saying, yeah, you're qualified for this loan. It looks like you should be good. A pre-approval is a much deeper sort of dive, look at all the documents, the tax returns, the W-2s, the bank statements, to ensure that they meet the guidelines of that particular loan. There's another level that some banks will do and others won't. Many of the big banks don't have the time or capacity sometimes to do this. We, however, will do a pre-underwrite on a loan. So what does that mean? I have every bit of documentation that's required for the underwriter to say yes to that loan. I've submitted it, it's been reviewed by the underwriter, and they have stamped off that it's credit approved, contingent on a property.
And how would it benefit our buyers?
Well, in that case, when you've got that pre-underwritten loan, we can close in 15 days or less. We get the approved contract that you've been able to get your folks into. We get an appraisal. We get that back as quickly as possible, within a week or less, and then we're to the dock drawing table.
That sounds great. I mean, 15 days or less is super competitive, especially knowing on how many cash offers you may be competing with.
Right, and I've gotten feedback from folks that this pre-underwritten loan actually in some ways is preferable to an all-cash offer. Well, how could that be?
Yeah.
A loan versus cash, right?
Yes.
Well, cash sometimes is a little ethereal, right? Do they have verification or proof of that cash? Oftentimes, these cash buyers actually intend to get a loan, and they'll go through the process of getting a loan as well. With my pre-underwritten loan, we're able to actually have that verifiable documentation that the money's good, and that we can count on it being there. So there's a level of assuredness in the fact that it's been reviewed by an independent third party, other than just the buyer coming in and said, here, I'm good.
Wow, this is great. It looks like basically pre-underwritten loans are basically loans half done.
They are. We need a contract, we need an appraisal,
and that's it.
And that's it.
And you're ready to close.
Correct.
Yeah, that sounds very, very impressive.
Well, that's what's necessary in this environment to help folks be able to be competitive and to be able to get into a home.
Absolutely, absolutely. Another question I wanted to ask you: what is the difference? Like many of our clients having choices between going to a big bank, one of the banks that they're, having accounts with, like B of A, Wells Fargo, Citibank, or going for the mortgage or for the residential loan to a brokerage.
Good,
So,
very good question.
yeah.
There are some excellent big banks out there, but not every bank is made the same. In fact, when we're talking about jumbo loans, and those are loans now that are over $679,000, and if you're buying a home in this area, you're typically using a jumbo loan. Those loan rules are actually written by the individual banks, and they all have slightly different guidelines. And so, how you make your money might be a guideline that is different. So, if you're self-employed, the way that a bank, looks at that versus bank B down the street looks at it might be different. Or if you happen to get part of your compensation in stock through RSUs,
Mm-hmm.
some banks will accept that, others won't. Another difference that can be major for people is the amount of reserves that are required to be able to get that loan. How much money do you have to have post closing that's liquid
Right.
as emergency reserves? And so all those things are differences that the banks have in terms of their requirements for those loans. And you might not know going down the street, is my bank the one that fits my situation best, or is it not? And so a broker has the capacity to be able to work with all of those scenarios and one-stop shop.
Todd, let's talk about appraisal process. We
Okay.
all know that appraisal is an opinion, is a qualified opinion of a licensed individual, but it's still an opinion. It's not a fact. It's not like, okay, this cup is, weighs whatever, like half a pound.
That's true.
So,
Yeah.
can you talk about it?
Well, yeah, the appraisal is a critical piece of the loan process. It's the bank's opportunity to check out the collateral, right, that's going to be pledged for that loan. And they use an independent third party, an appraiser, who's licensed to do that. But it's their opinion, right?
Mhm.
Well, that opinion is based upon the data that's available. So there are very specific parameters that they look at. It has to be close in proximity in terms of time of closing. All right, it has to be close in proximity for location. It has to be close in amenities and size of property. And so they have all these different parameters that they look at. It really operates on a theory of substitution. All right, I'm looking to buy this house. There are these others around that have sold recently. If I were to substitute one of those for that particular house, what would the value be? Is it supported by the market? That could be a challenge, as you know, in this market where
Right.
prices are rising rapidly, right? And there's only so much data.
Right. I also understand, like from my experience working with the buyers, that when market is rising rapidly, so what we're dealing with, where appraisers are not dealing with the most current data because they can only use as comps, they can only use houses on which escrow is already closed.
That's correct.
But it gives us approximately at least 30 days old comps. And during this last 30 days, market may go up even more. So the freshest and the most accurate data are in pendings,
That's correct.
which appraisers cannot use.
Well, appraisers typically will put one or two active listings in as well to show what those are. The challenge with that might be, how was that property marketed and priced? Was it priced lower than what the market is? Trying to fish out multiple offers.
Right. Like listing price cannot be a valid comp.
But that's the only piece of data.
Pending price, but even something that's currently pending, even like today's contract price, still on the way to close may change.
That's
People
correct.
still can renegotiate something, things happen, so it's not like 100%
That's absolutely
valid comp.
Exactly. So that's not given the most weight. The most weight is given to those most recently closed sales that are as close in characteristic to the subject property that we're looking at. And so it's a challenge. So people who are buying, it's good to work with a seasoned agent that can help them do an analysis of what the market is saying, not only about where it's headed price-wise in the future, but where it's been and what are the contingency factors that you might have should the appraisal come in short. Do you have the additional cash, or can the loan be restructured in such a way that you can still afford that house if the appraiser is unable to provide the data that's going to support that? Now, that doesn't mean the property is not worth what you're paying for. It's just that the market is moving quickly, and that's the challenge.
Yeah, it doesn't matter what people think it's worth. It's what really matters. If there is one person who is willing to pay the price, because if they're willing to pay and seller is willing to accept, that constitutes market price. That's
Well, that is the definition of market value. What's a willing buyer and willing seller willing to come to agreement on,
it. Right.
right?
Absolutely.
But can you get the data to support it?
Right. So I think that the most valuable characteristics of a buyer, or let's say buyer agent couple, whatever, is ability to understand and predict the actual sales price. So it should not be viewed as some kind of gambling or some kind of lottery. There are actually a set of very specific factors that will determine the outcome. And we know that top agents can predict them. And factors vary from style of the house, like a brand new contemporary style house or brand new traditional style house. If you know demographics of population that have money to buy, you probably will be able to address this question. And there are many parameters like this. Also, investment value of the house, like this nice house on a big lot with good school district, or as nice not on such a big lot and close to a busy street. So we have lots of factors like this. All right, Todd, thank you so much for coming. It was a pleasure having you here.
I really enjoyed it. Thanks for having me, and I hope that it was helpful for you and for your viewers.
Of course. So if you guys would like to contact Todd, so please look for his contact information below. And thank you so much for watching.